What's the maximum loss with a collar strategy? Have you ever wondered how much you could potentially lose when using a collar strategy in options trading? Let's break it down in simple terms. The maximum loss in a collar strategy is not just a random number. It is defined by a few key factors. These include the price you paid for the stock, the strike price of the long put option, and any net premium you received or paid when setting up the collar. To understand this better, let's look at the formula. The maximum loss equals the stock cost basis minus the long put strike price, adjusted by the net premium. This means you can calculate your potential loss before entering the trade. Now picture this scenario. You own shares of a stock at a specific price, which is your cost basis. To protect yourself from a drop in the stock price, you buy a put option at a strike price below your cost basis. This put option acts as a safety net, allowing you to sell your stock at that strike price if the market price falls below it. To help cover the cost of the put option, you sell a call option at a strike price above your cost basis. This call option generates income, which can offset the cost of the put. However, it also limits your potential gains if the stock price rises significantly. Let's say you bought a stock for $100. You then buy a put option with a strike price of $95 and sell a call option with a strike price of $105. If the premiums from these options net to zero, your maximum loss would be $5 per share. This is calculated by subtracting the put strike price from your cost basis. If the stock price drops below $95, your put option kicks in, and your losses stop there. You have effectively limited your downside to that $5 difference. However, if the stock price rises above $105, your gains are capped at $5 per share since the call option will be exercised. In essence, the collar strategy is a risk management tool that helps you limit losses to a known amount. It allows you to protect against significant downturns while giving up some upside potential. The exact maximum loss will depend on the specific strike prices you choose and the net premium involved, but it will never exceed the difference between your stock cost basis and the put strike price, adjusted for any premiums. So, when considering a collar strategy, remember that it offers a way to manage your risk effectively while still participating in the stock market.